Hello everyone, today we're diving deep into one of the most infamous corporate collapses in history, the Enron scandal. In 2001, Enron Corporation, once the seventh largest company in the United States, went from a market value of over $60 billion to complete bankruptcy in just months. Shareholders lost around $74 billion in the 4 years leading up to the collapse. This is the story of how it happened, step by step. Enron was formed in 1985 through the merger of two natural gas companies, Houston Natural Gas and Intranorth. Kenneth Lay became the CEO and chairman of the new company, which was renamed Enron in 1986. In the early 1990s, the US government deregulated the natural gas and energy markets. This allowed companies like Enron to trade energy as a commodity. Jeffrey Skilling, who joined as a consultant and later became president and COO, pushed Enron to shift from traditional pipeline operations to energy trading and derivatives. In 1992, the SEC approved Enron's use of mark-to-market accounting. This method let the company record projected future profits from long-term contracts as immediate revenue, even if the cash hadn't come in yet. This made Enron's financial statements look incredibly strong. By the late 1990s, Enron was reporting massive revenues, over $100 billion annually at its peak, and its stock price soared to around $90 per share in 2000. The main figures included Kenneth Lay, founder and CEO/chairman. Jeffrey Skilling became CEO in February 2001. Andrew Fastow, Chief Financial Officer who created the complex financial structures. Their auditor, Arthur Andersen, one of the big five accounting firms at the time. Enron used special purpose entities, or SPEs, to hide debt and losses off its balance sheet. Andrew Fastow set up partnerships like Chuco in 1997, LJM, and the Raptors. These entities were supposedly independent, but Fastow and other Enron executives controlled them. They moved failing investments and billions in debt into these SPEs, so Enron's main books looked clean and profitable. For example, they would sell assets to these partnerships at inflated prices, book huge profits, then guarantee the partnership's loans with Enron stock, creating a circular risk. Mark-to-market accounting exaggerated profits from future energy trades. When deals underperformed, instead of reporting losses, they hid them using these off-balance sheet vehicles. This kept debt hidden. Estimates say billions were concealed, while inflating reported earnings. Arthur Andersen approved many of these practices, earning large fees from Enron, over $50 million in 2000 alone for audit and consulting. The cracks started showing in 2001. February 2001, Skilling becomes CEO, Lay stays chairman. August 2001, Skilling suddenly resigns after just 6 months, citing personal reasons. Lay returns as CEO. Around this time, Vice President Sherron Watkins sends an anonymous memo to Lay, warning about potential accounting issues. October 2001, Enron reports a $618 million third-quarter loss and reveals a $1.2 billion reduction in shareholder equity due to partnerships. Stock starts dropping sharply. Mid-October, the SEC launches a formal investigation into Enron's accounting and related party transactions. November 2001, Enron tries to merge with Dynegy to survive, but the deal falls apart on November 28th. Stock plunges below $1 per share. December 2nd, 2001, Enron files for Chapter 11 bankruptcy protection, the largest in U.S. history at the time, with $63.4 billion in assets and massive hidden debt. The stock fell from over $90 in 2000 to pennies. Thousands of employees lost jobs, around 4,000 immediately, and their 401k retirement plans, heavily invested in Enron stock, became worthless. Arthur Andersen was indicted for obstruction of justice after shredding Enron-related documents once the SEC investigation began. In June 2002, Andersen was convicted, lost its license to audit public companies, and effectively collapsed, putting tens of thousands out of work. The conviction was later overturned by the Supreme Court in 2005 due to jury instruction issues, but the firm was already gone. Enron executives faced charges. Andrew Fastow pleaded guilty to fraud and conspiracy in 2004, cooperated with authorities, and served over 5 years in prison. Jeffrey Skilling was convicted in 2006 of conspiracy, fraud, and insider trading. Originally sentenced to over 24 years, later reduced and released in 2019. Kenneth Lay was convicted on multiple counts of fraud and conspiracy in 2006, but died of a heart attack before sentencing. Over 20 people were convicted in total related to the scandal. The Enron collapse exposed massive flaws in corporate accounting and oversight. It remains one of the biggest corporate fraud cases ever. That's the full story of how Enron went from energy giant to total disaster. Thanks for watching. Subscribe for more case studies.